Hey everyone, welcome back to Corporate Decoder, the place where we untangle those complicated corporate filings. Today we are diving into LanzaTech's latest annual report. Get ready, because this one is a roller coaster with a possible take-private deal that might leave investors feeling more like they've been taken for a ride. LanzaTech, a company trying to turn pollution into useful stuff, is facing some serious financial headwinds. The big question is, can they turn things around, or are they headed for a deal that might not be so sweet for shareholders? This report is their Form 10K, an annual snapshot of their business, and it paints a pretty detailed picture. Right off the bat, they admit there's substantial doubt about their ability to keep the lights on. That's never a good start. This basically means their accountants aren't sure they can stay in business for the next year without some major changes. They are trying to cut costs, find partners, and maybe sell off some assets, but it is very up in the air. Adding to the drama, they have received an offer to be bought out, a take-private deal from Carbon Direct Capital. The offer is for just $0.020 per share. You can imagine how current shareholders might feel about that. The company is reviewing the offer, but there's no guarantee a deal will happen. One customer accounted for a quarter of their income this year, so that's never good. Makes you too reliant on one client relationship. If they lose that customer, it will cause massive problems. LanzaTech's entire technology is now at a make or break point. To succeed, it depends on a lot of parties to fall into place. Construction must be on time and budget. Their tech must work well, and the offtake agreements must go through. These all need to work for LanzaTech to even have a chance to prove its concept. Now let's dive into some of the numbers. They burned through $89 in cash just to operate, which is actually a bit better than the $97.30 million they burned through the previous year. Their net loss was $137.7 million this year, only slightly higher than the $134.1 million from last year. That is an ocean of red ink that needs to be fixed. Their interest income also fell, meaning they were making less money on what cash they did have on hand, a loss of 31%. Their liabilities are $161.20 million, dwarfing their total equity of just $13.4 million. They are in debt and need to make changes fast. One of their key government initiatives to help their business model is the California Low Carbon Fuel Standard, or LCFS. It helps make their product more appealing, but can also be repealed anytime, which would remove one of LanzaTech's competitive advantages. With projects in China, Japan, India, Australia, the UK and Belgium, they're exposed to a whole basket of international risks. This includes political and economic factors. They also rely heavily on trade secrets, which, unlike patents, can be tough to defend if someone figures them out or steals them. Like every company these days, cybersecurity is a concern and a risk. A security breach could cripple their operations. The stock price itself is a risk. It could go down, making it hard to raise money or keep investors. The market can be really volatile, especially for green companies like LanzaTech. A major collaboration for them is LanzaJet, where they have agreements with some huge names, but getting them to all agree and invest is a challenge. If LanzaJet fails, it hurts LanzaTech, especially as they have exclusively licensed some key intellectual properties to them. A big problem for the company is they have licensed some key patents to LanzaJet, which prevents them from doing sustainable aviation fuel themselves. If LanzaJet goes south, they've given away key assets and not received anything for it. They depend on other partnerships, especially joint ventures. If they can't find good partners or the deals fall through, they are back to square one. Construction delays and rising costs for their plants could throw a major wrench in their plans. Government grants have been helping them float so far. If the grants are not renewed, they sink. Losing any major partner could especially hurt them. They have some important relationships, but depend on the financial solvency of their partners to succeed. The carbon capture and utilization technology relies on government and corporate support. Without favorable policy changes or sentiment, they are dead in the water. They operate in China, where government rules and policies can change overnight, so that makes things very difficult. The Chinese government could throw a wrench into their joint ventures if it decides the agreements are not kosher. Finally, running a public company is expensive and takes up management's time that could be better spent elsewhere. Where does this leave LanzaTech? They have got a truly innovative idea, and with the right technology, maybe they can pull it off. It feels like LanzaTech is trying to shift their operations from research to actually building and deploying its technology, and that comes with its own set of risks. And now it comes with the offer from Carbon Direct. They might have some tough choices ahead if that take-private deal does not work out and they can't raise the money they need. Thanks for watching. If you enjoyed this corporate breakdown, be sure to like, comment, and subscribe for more deep dives into the world of business and finance.